Please read this disclaimer carefully before proceeding further. Hello traders. In this video, I'm going to revisit S&P 500 and I'll tell you exactly what I did to short S&P 500 and what was my thought process and why I went for one particular level. So it's going to be like complete reverse engineer of what I've been doing on S&P 500. Hopefully this is going to be useful to you. If you find this useful, do not forget to like and subscribe to this particular video, and let's get started. Right, so if you have been actually following my analysis on TradingView or YouTube or on my Telegram channel, then you might have seen me posting an idea on S&P 500 which is around somewhere around here. Yeah, that one. Two particular zones that I was interested in, and I was waiting for market to actually come into that zone and give us some kind of confirmation to actually go short on them. And since then market has actually reversed and it has been actually going down pretty nicely. So we are still not on the target as of yet, and we'll be managing our trade wisely depending on how the market actually reacts, because it may or may not reach the target, but we may be able to get a lot of profits out of this trade. So this was a short trade. I'm going to reverse engineer it for you from from start to end, so that you can understand what was my thought process behind this. So let's look at this. This is the original analysis. Now it is looking very messy because it has been developing over the weeks, over days. So what I'm going to do is actually pick up a fresh chart for you, and this is where it is. Right, so now if I go to the monthly time frame, there was a lot of volatility around here. Market sold off because of coronavirus. There was a huge rejection from this particular level, and it has been falling down, and I've been covering that in my weekly analysis for quite some time now. If we just focus on this particular chart, what we can see that this market has a tendency to overstretch itself. It is overstretching right there. As you can see, there is no real pullback on this particular rally. It has been overstretching. There was a little bit of reaction around here because it is kind of like sudden, and it actually involves it engulfs a few of the previous candles as well. So that was like this, pretty much like here, overextension, then sudden movement, and it engulfed 1, 2, 3 candles around here. Similarly here. Now this one was one of the biggest one. And what we can see from this point is that market has actually created this huge impulse now. This is an impulse, and now we are actually in correction phase. So as I said before in my analysis, that once the correction is over, we expect market to actually resume the previous trend. Right, so that's why I was bearish on S&P 500. I knew that at some point in time it will show a bearish move, either in this candle or in this candle. So we have been actually watching this market around important levels around here, and then we were actually waiting for market to actually give us that kind of indication. Now if I go to the weekly time frame, what I see here is that market has actually created a weird M kind of pattern here. I'm not sure whether you can actually spot this, but this is a weird kind of M pattern which has actually completed. Right, so when the M pattern completes, the market has tendency to go higher, and that's what has been happening. And if we look closely, we have actually a W pattern forming here as well. Again, this is a very weird one because we have very shallow retracement around here, but nonetheless this is actually a W. Now there is another W here which we'll see in a second when we go to the daily time frame. And that was one of the main reasons why we actually chose this particular spot to be a bearish spot. Now one of the things that you can actually do, which is very, very simple, and this is actually part of the course that I teach as well, is cross trend line. So one of the things that I spotted earlier on is this one. If I draw a trend line like this, and if I extend that, I can see that market is expected to come to this trend line and show me some reaction, and that is a very, very good indication for the market to actually show some reaction on higher time frame. If market does that, then we can actually go to the low time frame and we can plan our trade accordingly. Right, so this is one of the reasons why this was also a very good spot. However, even before that, as you know, if you have been following my analysis, as you know, I actually work on Fibonacci Confluence based analysis. Before we go any further, If you're interested in learning how to analyze the markets the way I do using Fibonacci Confluence, then head over to Vikinsa.com, and under training section you'll be able to see Core Strategy Training Program. On this page you'll be able to see the testimonials of previous students and also look at the brochure. The brochure has a lot more information including the course structure and the Fibonacci Confluence Training Program curriculum. This is a very extensive program in which we cover basic core Fibonacci concepts along with the advanced concepts to analyze the markets with high probability. If you're interested in joining this program, come to Vikinsa.com, and under training section you'll be able to see and submit this form. I need to start measuring these legs using Fibonacci tool, right? So because this is an impulse move, this is the biggest impulse move, right? So if I take the Fibonacci tool and draw from top to bottom, what I can see that market reacted around 38.7, then it reacted around 61.8. That means market was expected to react around 78.6 or 88.6, right? So because these are the major Fibonacci levels that we have, right? So that means that we have something of like bearish kind of move was expected around 78.6. Now I cannot say at this moment in time of this analysis that it was supposed to happen like this, no, because it needs to actually build up. We need to build our case up for our analysis and for us to find an excuse to enter the market. So now at 78.6 we were expecting market to show some reaction, so let's actually put a line there, and let's put a line around 88.6. right? Now if we do that, we should also be putting a line around 38.6 like this. Now what we can do is actually go to the daily time frame, and then we start looking into what sort of pattern it is forming. Now there are two kinds of pattern which are forming. One is this one, right? So if you see, you can actually draw something like this, and this was completing around 78.6, right? So that was one of the patterns that was actually forming right there. Another one was this one, which actually starts from this particular base, right? So this is another pattern. Sorry, if I draw it properly, this is another pattern which is forming, this is another pattern which is forming, and that actually completes right there, but sometimes it extends to 113 right there, right? So that is also one of the things. Now if we take both of these patterns, they actually line up nicely with those lines, right? And that means you can either draw a zone like this around those two complete pattern completion levels, or you can actually do something like this. This is what you see right there. Now if I come back, you can actually do this, or you can actually draw this entire thing as a zone, and then you look for a confirmation of entry right into there, right? So that was one of the reasons as well, right? So now how do we actually measure the probability of this, right? So if I go back to the monthly time frame, we were actually expecting market to actually fall down, so that's one factor, right? Second factor is if I go to the weekly time frame and I draw a trend line, this one, because that's the most recent one. So that is the second factor, that we were expecting market to actually fall back down. Now if I go to the daily time frame, what I can see that market is actually respecting that trend line around here, and then we are expected to show some reaction around here according to that trend line, and we also have those patterns completing right in that zone. So we have three major factors lining up in that zone, right? So we had multiple factors lining up for us to actually make decisions. These are very strong factors in our favor, right? These techniques and this entire thing that I've shown so far is actually part of my Fibonacci core strategy curriculum that I teach as well. You'll find a link in the description below if you are interested in joining that program. Right, so we were actually expecting market to actually react there, and that's why we were looking for an entry right in that place, right? On 4-hour time frame, what I can see that market tried to consolidate here, but if you look closely, that market was actually creating head and shoulders kind of pattern, and I knew that this was actually a head that has been created, and it was actually 3228 level right there. So as long as that head is protected, the market actually goes there and comes back down. I knew that market would would show some kind of bearish move right there. So this was the point of entry that I was looking at. On 1 hour time frame, it looks actually much better. This is left shoulder, this is head, and this is right shoulder, right? All head and shoulders pattern and double top and double bottom patterns are nothing but Fibonacci Confluence patterns. What we can do is actually start to look for a way to actually enter the market. Now remember, our bias is actually bearish, so we're looking for short opportunities. If you're a day trader, you could have actually played for some long positions as well in there, but because we are swing trading, we are actually looking for bigger bearish moves. So if you look here, there is an M pattern which is actually developing right there, and after an M pattern usually there is a W pattern, and when W pattern forms and completes, there is always a bearish move. Right, so we have a complex W pattern right there, and then we have another one which is actually right there. So when the market completed this is where I entered the market. Before we go any further, if you're interested in learning how to analyze the markets the way I do using Fibonacci Confluence, then head over to Vikinsa.com, and under training section you'll be able to see Core Strategy Training Program. On this page you'll be able to see the testimonials of previous students and also look at the brochure. The brochure has a lot more information, including the course structure and the Fibonacci Confluence Training Program curriculum. This is a very extensive program in which we cover basic core Fibonacci concepts along with the advanced concepts to analyze the markets with high probability. If you're interested in joining this program, come to Vikinsa.com, and under training section you'll be able to see and submit this form. So this is how it is looking. If I take the Fibonacci from about top to bottom, I can see that market has come to 61.8. That means market was expected to come to 78.6, right? But there is another pattern which is actually formed, which is like this, and that completes at 88.6 right there. So based on that pattern, I actually entered at 3228 right there, and I was able to actually take a position here, and that has been going well so far. So this is how I entered into the market right there. Now there is another technique that I use, is actually based on the water indicator that I developed, and if I go to the MT4, this is what we see, right? So if I just quickly replicate what we have seen so far, that's the trend line that we saw, and then if I expand it a little bit, and if I bring in water trend and water trend shift, right, and I change that to strict, and I remove these alerts. Okay, because the trend has shifted and there is an indication, that means we could have actually entered the short right there. But because this candle was huge, and after such a huge movement, there is usually a kind of like reaction upwards. It is like kind of retest. Market tries to go back to test that level, and this is the level where we actually just saw we had this pattern as well, right? So I was waiting for the market to actually go and complete that pattern. So what I saw on 4 hour, that there was an indication that market was supposed to go down, but because I knew that market could actually give me a better opportunity on the completion of that pattern that we just saw on 1 hour, I actually waited and actually entered that position at 3228. If I go to the 1 hour time frame, what we can see that this is the head and shoulders pattern, right? And if you wanted, you could have actually entered based on 1 hour time frame, or you could have entered based on a 4 hour time frame. So if you are on 1 hour time frame, which is actually not going to be as good as the 4 hour time frame, this was your entry signal. Now after the completion of that pattern, this was the signal. After the break trend line broken and trend has changed, the color has changed, you could have actually entered right there. Now we will ignore these green arrows because the trend is actually bearish right now, so we will just keep on ignoring those green arrows. You could have actually also entered right there, because on the break of the trend line there was an indication right there and market was like this. Now there is another one which is right there. You could have entered at that particular place. On 1 hour time frame, what we can see that market is actually showing a divergence. The price is actually kind of like consistent in that particular zone, but it is showing a divergence, right? So that also supported the fact that this was actually going down. This was a very good entry point. This was also a very good entry point. And if you wanted to get out of this particular consolidation before making any trade, then this would have been a very good indication right there to actually go short on this particular particular trade. So overall, this is how actually it worked out. So if I go back to the daily time frame, market has been falling down, and because we had this W pattern right there, what we can expect market to do is actually come to 38.2 Fibonacci level right there. However, because the market has been overstretching, and we know from the past history that it has tendency to overstretch, and usually when the correction comes, it is actually kind of like, you know, very quick, but it doesn't actually go very deep at times. So what we can do is actually we can expect market to actually come to 23.6 as our first target, and then 38.2. If the market becomes really bearish, then we can actually expect market to come to 61.8, which is going to coincide with the previous structure. Even on 23.6, you can expect market to actually come here, because we have this round number very close to this round number, which is 3000, and we have previous structure right there and right there. So far it has been looking good, and it has been going towards our first target of 23.6, and if that actually gets broken, we will wait for market to actually give us a confirmation right there. If the market actually goes back up and you see that it is giving you further confirmations, you can add to the short position, or you can start a new short position on this particular market. And other way to actually trade this is, if this is broken, then you can actually start looking for a short opportunity going into 38.8, 38.2. So this is what I did in S&P 500, and the trade is still running. Hopefully this is going to actually work out nicely as planned. And if you enjoyed this video, if you found this useful, then do not forget to like this video, and do not forget to share this video. Also subscribe to my channel for future videos like this, where I'm going to be covering more educational side of it, not just like, you know, trading analysis, but like, you know, giving you trading tips and all that. So do not forget to subscribe to the channel, and I hope to see you in the next video as well. Thank you. Thank you for watching. Find and follow us on these social media channels.